Well, good morning, ladies and gentlemen, dear friends. Very warm welcome to all. Let me say that it's a real pleasure for Banque de France and for myself to have the opportunity once again to organize this conference together with the Global Interdependence Center, the GIC. On a more personal tone, I unfortunately have to say, well, I first would like to say that my good friend David Kotok and I decided to launch this conference almost 10 years ago, the joint conference between GIC and Banque de France. But unfortunately, I have to say it's some wistfulness that I have to observe that this conference is the last that I will be attending, at least as governor of the Banque de France, since my term of office comes to an end on the 1st of November of this year. But as Jean Monnet said, people move on, but institutions remain, and I'm certain that there will be in the future the same common willingness to keep on strengthening the long-term and very fruitful cooperation that we have established between the GIC and the Banque de France. So I'll stop here my remarks and give the floor to John Sylvia, as GIC Vice Chair of Central Banking Series, to comment on the program of today, which promises to be, I must say, very exciting. I wish you all a very good conference. Thank you.
Well, thank you, Governor Noyer, for all your support over the years. And very simply, I want to certainly compliment David, Steve, and Michael for putting together a wonderful program today for all of us, and I welcome you here today. And I do hope that if we can take away a lot of discussion and commentary and keep an open mind to what the issues are, because it is a post-crisis environment, and there are a lot of focus on new policies, both with respect to macroeconomics, which we traditionally think of monetary and fiscal policy, as well as trade, and also the microeconomics of economic development and the organization of financial markets. So let us try to keep an open mind, have a good discussion, and think very thoughtfully about a post-crisis environment. I'd like to invite David and his panel to come up.
Good morning. It's a pleasure for me. I have had the experience of working with Christian Noyer for a decade. You said 10 years, but it's actually a decade. and it's also a pleasure to have this as my last panel, because John Sylvia is now the chair of the Central Banking Series, and Michael Drury is now the chair of the GIC, and Don Rissmiller is now the chair of the Program Series. I have nothing to do. So when you're finished, let's go sailing together. There's wonderful history, and I would ask for just 2 minutes to share it. Here we are in this extraordinary experiment with monetary policy in the world. Extraordinary. And we're going to hear 2 messages and then have a chance for a few questions. And I'm sitting here thinking about the fact that I know both panelists for years, and I want to say a word or two about each. Loretta Mester has a distinguished career in Philadelphia. She has had years of experience in preparing members of the FOMC for meetings and policy, directed an extensive research, and is affiliated with an institution called the University of Pennsylvania. I know a little bit about it. I could never get a visa to any other university. And she now is the president of the Cleveland Fed, sits on the FOMC, and has to deal with monumental policy issues, and we'll hear about them, with respect to the Federal Reserve. Imagine if you had asked her over the years, will you be in this position and be in the debate over these policy issues? And I would suspect she's prepared now, as prepared as one can be professionally, to confront, which is a worldwide question about monetary policy. Christian Noyer is an observer of the creation of the euro. I remember when we first met at the Dallas Fed, and the euro was a baby. And you think about his career, which is also extraordinary and deep. And if you had asked him 10 years ago, would we be in the position we're in? Would we confront the reserves in the world? Would we be dealing with interest rates at zero or below zero or near zero? I suspect he would have said, I don't see it. And yet now, both of our panelists, with long history and skills in making policy, one will give us their messages, and two, if you think about it, they represent the two largest reserve currencies of the world. Now, all of the other places are very nice places to visit. But as a practical matter, the reserves of the world are in US dollar and euro. So we're in for a wonderful, wonderful treat, and then we'll have some conversation. And for me, as the retired GIC program chair, it is an honor and a privilege to be with two friends for this panel. So, Christian, you're going to begin, I think? Okay, let's go. We'll go to work.
Thank you very much, David, for your very kind words, and well, it's a real pleasure, I must say, to share this panel with both of you this morning. I'm gonna say a few things about the size of central bank balance sheets and the relevance, or how relevant is that. And starting with facts, in all major economies, central banks' balance sheets have, of course, dramatically increased in size and also as a percentage of GDP. That movement was, I'm speaking of some time ago, temporarily reversed in the euro area, but our balance sheet is set to increase again, as you know, following the recently decided and implemented asset purchase program, most notably part of it that is called the public sector purchase program. Since 2007, the aggregate size of central banks' balance sheets over the world has in fact tripled. It has reached the amount of $22 trillion at the end of last year. And interestingly, this increase has almost been equally split between advanced and emerging economies. In advanced economies, we all know central banks have acquired domestic assets, and on average, their balance sheets have grown from 10 to 20% of GDP over the last 7 years. In emerging economies, it has been essentially the accumulation of foreign exchange reserves, which accounts for most of the expansion. Of course, situations remain diverse, in particular among advanced economies. For instance, the balance sheet of the Bank of Canada amounts to about 5% of its nation's GDP, where the Swiss National Bank holds assets equivalent to 80% of the Swiss GDP, and of course, for quite a lot, it's foreign assets. There are discretionary and technical factors that both explain those differences and evolutions. The former holds for countries that chose to accumulate foreign exchange reserves. The latter is topical in the case of the euro area. The ECB's balance sheet, or the Eurosystem balance sheet, I should say, performs an intermediation function between national central banks through the so-called Target 2 system. So, as a mechanical phenomenon, balances in the system tend to grow in times of market segmentation. That is, while there is an impaired interbank market and strong capital flows inside the euro area. Similarly, conducting monetary operations via open market or via repos makes the size of the balance sheet more or less dependent on the size of the interbank market. This being said, of course, the recent increase in size mainly results from a shift in the monetary policy regime. Central banks have taken a proactive rather than purely passive approach to their balance sheets. They have, according to the common parlance, put these balance sheets to work. And as a result, in the formulation of monetary policy, quantities, the amounts of assets and liabilities, have come to play an increasing role as compared to prices, the level of interest rates. This, of course, is a component and a consequence of unconventional monetary policies. Traditional channels through interest rates have become ineffective, first of all because economies have hit the zero lower bound, and in some cases, like the euro area, because transmission through credit has been clogged, at least in some parts of the area. The expansion of balance sheets then results from attempts to overcome those limits and allow monetary policies to fulfill their mandates via a large scale of asset purchases. Now, an interesting question is the following. Is it the size of the balance sheet or the means of its increase that matters most? The causes and consequences of changes in balance sheet size are rather diverse. Broadly speaking, broad liabilities and assets of central banks matter. An expansion of liabilities occurs when, as the Eurosystem did in many instances, the central bank increases liquidity provision to the banking sector with the explicit objective of easing pressures on funding, reducing its costs, and ultimately influence lending behavior. Expansion of liabilities may be more passive when setting an exchange rate floor, such as in the case of the SNB, the Swiss National Bank. So looking now at the asset side, asset purchases bring down risk premia, they trigger portfolio rebalancing, they flatten the yield curve, they increase risk-taking in the private sector, and they shift expectations in a more positive territory. As you all know, the Eurosystem has now embarked into a major purchase program, the so-called PSPP, that follows other programs of smaller sizes for asset-backed securities and covered bonds. There are many technical discussions. Some people would argue that the stocks of assets held by central banks matter more than the flow of purchases. Others would contend that the composition and size of purchases are the real levers. The issue, in fact, boils down to whether an expansion in the monetary base is enough to trigger credit expansion, or whether the latter is correlated to banks' willingness to expand credit and, more importantly, on the appetite of economic agents to borrow. Well, based on how monetary policies have been conducted for the past several decades, I think banks have always had the ability to expand credit at a given level of interest rates, irrespective of the size of the central bank's balance sheet. And being at the ZLB does not change that simple reality. Hence, I would tend to argue that given the transmission channels of an asset purchase program, its composition and length may matter as much as its size. In any event, increasing the size of the balance sheet for large-scale asset purchases sends very important signals. This signaling operates at several levels. It may contribute to strengthening forward guidance on the policy rates. More importantly, it may have a direct impact on inflation expectations, therefore contributing to lower real interest rates. When the balance sheet size is explicitly linked to the achievement of an inflation objective, as for instance in Japan, it may prove an effective tool to communicate the monetary authority's determination, what economists would call a commitment device. Well, signals on the Eurosystem balance sheet have played a great role in the recent past. In November 2014, the Governing Council stated that the balance sheet was expected to move toward the dimensions it had at the beginning of 2012. Markets then started to anticipate an asset purchase program. More recently, this asset purchase program, which will last until end September 2016, I said that to simplify, has been an important and clear signal of the monetary policy stance over an extended horizon. And those signaling effects have been very effective. And following the announcement of the expanded asset purchase program on the 22nd of January, significant movements took place on financial markets with inter alia a new decline in the forward interest rates across all maturities, a new decline in government and corporate debt yields, and a rise in equity prices. Now, having said that, another interesting question is to wonder whether there are drawbacks to be feared from the increase in the balance sheets of central bank. And indeed, the active use of their balance sheets by major central banks has raised a number of concerns. And I shall focus on three questions. First, when unconventional monetary policies started to be implemented, many analysts were worried that the expansion of the monetary base would trigger inflationary pressures and central banks would eventually lose control over price stability. As we all know, the reverse happened. Broad money aggregates have been basically flat, at least that's the case in the euro area, over the last 18 months. And the money multiplier collapsed and inflation has decreased well below a definition of price stability, even core inflation. Second, other questions are raised as to the quasi-fiscal implications of central banks' balance sheets. There is a perception that expanded balance sheets create a new environment where the relationship between central banks and governments gets more complicated. Basically, the expansion would expose central banks to new risks, increase their vulnerability, and compromise their independence. And third, there is a huge theoretical literature on central bank solvency. And I read the conclusions as follows. Nearly all analysts agree that a central bank cannot go technically bankrupt, as it can issue as much currency and reserves as needed to face its payments and commitments. And indeed, in the past, a few central banks with sometimes great reputation have operated with negative net equity for long periods of time. Most economists would argue, however, that unlimited issuance of base money would certainly endanger price stability in ordinary circumstances. So while the existence of a central bank cannot be put in danger technically by technical insolvency, its ability to fulfill its mandates might certainly be compromised, and so would its independence, as the central bank would depend in the end on the government to rebuild its capital. It is very important to understand that the Eurosystem is very well, maybe fully, we could say, protected against such a contingency. Why? Because it has been created with a very solid capital base. It has kept strengthening it through retained profits and occasional recapitalization. The Eurosystem is probably unique in this regard amongst advanced economies. and both its independence and ability to fulfill its mandate are guaranteed in very adverse economic circumstances. While, of course, it should not lead to complacency and negligence, the existence of that kind of buffers should alleviate any concerns about the potential risks that the expansion of the balance sheet may entail. Finally, huge central banks' balance sheet may be seen as influencing the allocation of resources or affecting implicit fiscal transfers, an issue of special sensitivity inside the euro area, as you may know. To discuss this question, it might be useful to refer to the famous Musgrave classification of public policies between three purposes: allocation, distribution, and stabilization. And there is no doubt that monetary policy is only and exclusively concerned with stabilization, and a very focused part of it, by the way, price stability. No monetary policy action should be taken for any other purpose. So, to the extent that unconventional tools are implemented, there should be no ambiguity as to their close link with the central bank's mandate of price stability. I believe that has been the case in all major countries, and certainly so in the Eurozone. Now, a good question to ask ourselves is if there are unintended consequences of such policies, can we mitigate them? The truth is that the real world does not always fit perfectly with the beauty of Musgrave's classification. Some public policies may aim at several objectives, others may inadvertently have unintended side effects. All public policies, with no exception, health, energy, infrastructures, unwillingly affect some citizens more than others. Those side effects should be minimized, but cannot always be totally avoided. And monetary policy, I believe, is not immune from the complexity of the real world. For instance, some unconventional policies may have or have had unintentional distributional consequences by pushing up asset prices as benefiting some households with important financial wealth. On the other hand, fostering economic recovery and reducing unemployment goes exactly in the direction of helping the most vulnerable part of the population. In other cases, strong intervention may raise legitimate moral hazard concerns. Should central banks have refrained from acting because of those consequences, at the risk of not fulfilling their mandates? Those simple questions remind us that decision-making always involves some trade-offs. It is all the more important that policymakers keep a clear focus on their ultimate objective. Central banks should certainly do their utmost to avoid any undesirable allocation or distribution effects of their policies, and so those policies should be designed as neutrally as possible. But this being said, the possibility of unintended side effects should not paralyze decision-making when required by the situation in order to fulfill their mandates. The ECB and the Eurosystem have faced such a situation when deciding on the program of large-scale asset purchases. I believe the decision taken reflect an appropriate balance between the necessity of achieving the mandate and the desire to avoid undesirable side effects. Key principles underlying the implementation of the PSPP, the Public Sector Purchase Program, have been the minimization of unintended consequences and full neutrality, as illustrated, for instance, by the choice of the capital key in the ECB to allocate purchases between various sovereign debts. It is also important to note that unwanted side effects can be minimized if different public authorities operate in a well-defined and respected framework. We have such a framework in the Eurozone. It is based on fiscal discipline, leading eventually to debt reduction. If those disciplines are not respected or implemented with insufficient vigilance, then monetary policy through public sector debt securities purchases may be perceived as creating strong moral hazards, thereby weakening the necessary consensus and compromising its efficiency. When fiscal transfers take place between countries in the Eurozone, they are implemented through mutually agreed and conditional programs. There are, of course, permanent temptations to blur the distinction between those fiscal programs and the monetary and liquidity operations of the central bank. Those temptations should be resisted, and this is the reason why the Eurosystem has been extremely rigorous in implementing its collateral rules in a transparent and neutral way. Now, let me conclude. Unconventional monetary policies are necessary, but they are complex. They create more interference with markets than policies conducted in ordinary times. As a consequence, it becomes more difficult to avoid unintended spillovers of stabilization policies on the allocation and distribution of resources. This reality should not prevent central banks from acting decisively when there are risks for price stability. But such actions demand rigor and precision in their implementation. For central banks, the balance sheet has become the main tool of monetary policy for the foreseeable future. It has proven effective. It can and will be deployed all the more efficiently than the rest of the policy environment remains sound. I'll stop at there. Thank you.
Good morning. It's a real privilege to join you at this event organized by the Global Interdependence Center and the Banque de France. I am proud to say that I've had an association with the GIC for many years, as David remarked, and I've always valued the insights I've gleaned from attending GIC events. I'm very grateful that David Kotak, John Sylvia, and their colleagues have invited me to participate in today's program, which is part of the GIC's Central Banking Series. Today's topic, new policies for the post-crisis era, is quite timely. Although policymakers in the United States and Europe face distinct economic environments, we face similar challenges in determining the most effective policies in those environments. So I plan to share a few thoughts about monetary policy on my side of the pond. In particular, I want to discuss some of the plans that the FOMC has for policy normalization. But to put that into context, it's important to understand how we got to this point. So I'll start with a review of some of the monetary policy actions the Fed took to address the financial crisis and Great Recession. As always, the views I'll present today are my own and not necessarily those of the Federal Reserve System or of my colleagues on the Federal Open Market Committee. In response to the financial crisis and deep recession, the Federal Reserve took some unprecedented policy actions. The Fed's policy body, the Federal Open Market Committee, or FOMC, has run an extraordinarily accommodative monetary policy to promote our goals of price stability and maximum employment. The FOMC has kept its policy rate, the federal funds rate, at essentially zero since the end of 2008, and it's used forward guidance to communicate the anticipated future path of policy. In addition, to exert downward pressure on longer-term interest rates, it's purchased large volumes of longer maturity Treasury securities and mortgage-backed securities guaranteed by the housing-related U.S. government-sponsored enterprises Fannie Mae, Freddie Mac, and Ginnie Mae. This extraordinary accommodative monetary policy has provided important support to the U.S. economy, helping to promote stronger labor markets and the pickup in growth that underlies my projection of a gradual return of inflation to our 2% goal over time. But it's also presented some challenges for the FOMC in returning to a more normal policy setting framework. To understand those challenges, it helps to review some of the major policy developments since the crisis. Some of the Federal Reserve's policy actions were aimed at addressing the stresses that emerged in financial markets in 2007 and 2008. Other policy actions were focused on easing monetary conditions to promote the Fed's dual mandate goals of price stability and maximum employment. The Fed's first action in August 2007 was to cut the primary credit rate, the rate that banks pay to borrow from the Fed's discount window, by 50 basis points to 5.75%. This action was taken to encourage liquidity-constrained institutions to borrow from the Fed. The following month, the Fed began lowering the Fed funds rate target, starting from 5.25% before the September 2007 rate cut, and ending at essentially zero in December 2008. This was an unprecedented step into a new monetary policy regime. The Fed's funds rate has been effectively at the zero lower bound ever since. During this period, the Fed also responded to the crisis by implementing a number of unprecedented lending and liquidity programs, but in the interest of time, I won't review them here. The Fed's actions did help stabilize financial markets. However, the real economy had suffered a lot of damage. The U.S. unemployment rate rose from about 5% before the recession to its peak of 10% in October 2009. Over the course of the recession, core inflation fell from around 2% to about 1%. Ordinarily, such conditions would warrant further reductions in the policy rate. But with the Fed funds rate at its zero lower bound, the Fed engaged in non-traditional policies to support the economy. In particular, between December 2008 and October 2014, to put downward pressure on longer-term interest rates, the Fed purchased large volumes of longer maturity U.S. Treasury securities and agency mortgage-backed securities. Now, large-scale asset purchases are thought to affect longer-term interest rates via a couple of channels. The first channel relies on segmented markets. When financial markets are segmented, either because arbitrage is disrupted, as it was during the financial crisis, or because certain market participants prefer particular types of assets, then assets are not perfect substitutes. In such a situation, when the central bank reduces the supply of longer-term assets by purchasing a large volume, the prices of those assets should rise and the term premium on the assets should fall. As investors begin to replace those assets with others, their prices will rise too, so there can be a transmission to assets beyond those being purchased by the central bank. A second channel through which large-scale asset purchases are thought to affect longer-term interest rates is via a signaling channel. The purchases signal that the central bank intends to keep policy more accommodated than the public currently expects. Thus, the purchases can be viewed as a form of commitment for policy forward guidance, another policy tool that the Federal Reserve has used during the unusual economic circumstances of the past 6 years. The formulation of the Fed's forward guidance on the future path of interest rates has changed over time, from qualitative guidance to calendar dates to economic thresholds and to a blend of state contingent and date-based guidance. In extraordinary economic times like those we've experienced in recent years, forward guidance is more than a communications device. It is a tool of monetary policy that has the potential to increase the degree of monetary policy accommodation, especially when interest rates are essentially at their zero lower bound. By reducing uncertainty about the future path of policy, forward guidance can help lower interest rates by reducing the premiums investors demand to compensate them for interest rate uncertainty. In addition, in theory, if the central bank indicates that the future path of short-term interest rates will be low for a long time, perhaps lower and for longer than would have been consistent with the central bank's past behavior, this can also put downward pressure on longer-term interest rates, thereby spurring current economic activity. According to the theory, if people believe the central bank is committed to keeping rates very low, they will expect higher economic activity and higher inflation in the future. When households, businesses, and market participants are assured of better economic prospects in the future, they should be more willing to make investments in capital and labor today rather than delaying them, and this will help the current economy. There's been considerable study of the effectiveness of these extraordinary policy tools, especially the Fed's large-scale asset purchase programs. Federal Reserve Board Vice Chairman Stanley Fischer recently reviewed the empirical evidence on how effective the Fed's purchase programs have been in lowering longer-term interest rates, and discuss the results of the recent Board of Governors staff study on the effectiveness of the purchase programs along with the forward guidance on the macroeconomy. In general, the studies find that the Fed's various asset purchase programs have lowered longer-term yields, and the staff study finds that purchases and forward guidance have had an impact on the macroeconomy. But as the Vice Chair pointed out, estimated magnitudes vary quite a bit across studies and are surrounded by wide bands of uncertainty. There is, however, no uncertainty about the dramatic change in the size and composition of the Federal Reserve's balance sheet as a result of the purchase programs. Assets on the Fed's balance sheet have increased fivefold, from less than $900 billion in July 2007 to about $4.5 trillion today. On the liability side, banks hold more than $2.5 trillion in reserves at the Fed, most of it in excess of that required to meet reserve requirements. In terms of composition, before the actions taken to combat the crisis, about 90% of the Fed's assets were treasuries and none were agency securities. Now about 55% of the Fed's assets are treasuries and almost 40% are agency MBS. And of the Fed's treasury holdings, over 50% have a maturity of more than 5 years compared to about 20% before the crisis. Today, the Fed holds very few short-term treasury securities. The changes in the Fed's balance sheet, as well as the evolution of the Fed's forward guidance, have raised some challenges about how to move back from extraordinary monetary policy to ordinary monetary policy, what the Fed has called normalization. In my remaining minutes, I'd like to discuss some of the Fed's plans for addressing those challenges. The FOMC has actually been preparing for normalization for quite some time. The FOMC first laid out our exit strategy principles in June 2011. These were updated last September to take into account the changes in the Fed's balance sheet. Just as it did before the Great Recession, the FOMC plans to implement monetary policy by adjusting short-term interest rates. It will communicate changes in the stance of policy by changing the target range for the Fed funds rate. But because the level of excess reserves held by banks is now much larger, the tools the FOMC will use to move the Fed funds rate into its target range will be different than before the crisis. In particular, in October 2008, Congress gave the Fed the authority to pay interest on the reserve balances that banks and other depository institutions hold at the Fed. The Fed will use the interest it pays on excess reserves, the IOER rate, as the main tool for moving the funds rate into the target range. Raising the IOER rate will put upward pressure on the Fed funds rate because banks will be unlikely to accept a rate in the market lower than the one they could get by depositing their funds at the Fed. We expect that while reserves are so plentiful, and because not all financial institutions holding reserves are eligible to receive interest, that the Fed funds rate will trade somewhat below the IOER rate. In addition to IOER, the Fed will use other tools as needed to ensure adequate control of the policy rate. One of those tools is an overnight reverse repurchase agreement facility. Overnight reverse repos, or ONRRPs, involve the Fed selling securities from its large portfolio of assets with an agreement to buy them back the next day at a predetermined price from eligible counterparties, including banks, primary dealers, money funds, and government-sponsored enterprises. By offering a safe overnight asset for a broader array of money market participants, some of whom are not eligible to receive interest on reserves, overnight reverse repos should help put a firmer floor on the Fed funds rate. These counterparties should be reluctant to lend their liquidity in the market at rates lower than what they could get at the Fed via this facility. The Fed has been testing overnight reverse repos, and the results to date suggest they have been helpful in firming the floor on money market rates. The FOMC has indicated that the overnight reverse repo facility will be used only to the extent necessary and will be phased out when no longer needed to help control short-term interest rates. This will help to ensure that the facility doesn't lead financial institutions to permanently change the way they do financial intermediation. In addition, the Fed has been testing usage caps on overnight reverse repos and other design features. These would help mitigate the possibility that during times of financial stress, the facility itself would attract liquidity from the market, thereby increasing the level of stress in the market. And the Fed is considering other tools like term deposits and term RRPs that could absorb some of the excess reserves in the banking system. The Fed's ability to pay interest on excess reserves, along with supplementary tools like overnight reverse repos, will allow the Fed to move interest rates up to target when it's appropriate to do so, despite the large size of the Fed's balance sheet. Over the longer run, the Fed's balance sheet will return to a more normal size and composition. The FOMC intends to reduce security holdings in a gradual and predictable way, primarily through ending reinvestment of principal payments on securities it holds and letting the securities mature and run off the balance sheet. At this point, the FOMC doesn't anticipate selling the agency mortgage-backed securities on its balance sheet as part of the normalization process, although it might engage in limited sales in the longer run to reduce or eliminate residual holdings. The evolution of the language in the FOMC statement, in particular its forward rate guidance, also poses some challenges for the FOMC. While explicit forward guidance was used as a policy tool during the recession and earlier in the recovery, in more normal times, away from the zero lower bound, I believe forward guidance should be viewed more as a communications device. As such, I'd like to see the forward guidance evolve over time to give more information about the conditions we systematically assess in calibrating the stance of policy to the economy's actual progress and anticipated progress toward our dual mandate goals. It would articulate the considerations the committee would take into account when determining future changes in policy, as well as information to help the public anticipate how policy is likely to change in responses to changes in economic developments that affect the economic outlook. To the extent that households and businesses understand policymakers' reaction function, their policy expectations will better align with those of policymakers, thereby making policy more effective. As normalization proceeds, I expect we'll be able to make more progress along these lines. In summary, the Federal Reserve took some unprecedented policy actions in response to the financial crisis and deep recession. These extraordinary actions help support progress towards the Fed's goals of price stability and maximum employment. At the same time, they present some challenges for a return to ordinary monetary policy making. But the FOMC has plans to address those challenges. It's laid out how it anticipates conducting monetary policy during normalization. In addition, the Federal Reserve's forward guidance on the future path of policy has been evolving. Now, most times in life, moving from extraordinary to ordinary is considered a bad thing. In the case of monetary policy, such a move should be viewed as a good thing because it means conditions are in place for a sustainable economic expansion with maximum employment and price stability. Thank you.